Hi, Nikita Burdick with Prosperity Lending, and I want to talk about what is a mortgage bond. Okay, and this is very important because mortgages are turned into mortgage-backed securities, or the UMBS, and the treasury bonds are also important to watch. So in order to understand how rates move, which is such a hot topic in 2022 when this video was recorded, you need to understand what a mortgage bond is. First of all, mortgages are based on mortgage-backed securities, or you'll be heard to them referred to as the UMBS. However, keep in mind that treasury bonds matter as well. Mortgage bonds are not, let me repeat, are not tied to treasury bonds. However, they do matter. As such, it's important to have an idea of what a treasury bond is. First, for treasuries, they all have different maturities, meaning how long will the bond be out there. Treasuries are considered less risky because they are backed by the full faith and credit of the U.S. government. It is risk-free in the sense that you will get your money back, but pricing is not risk-free. Different maturities have different names. If the maturity is 1 year or less, then it is called a treasury bill. If the maturity is 1 to 10 years, then it is called a treasury note, or 2 to 10 years. Greater than 10 years is called a treasury bond. We are most concerned with the treasury bond when we are looking at mortgage rates because the duration is similar to the UMBS in the fact that they are both long-term notes. Even if a treasury bond only has 2 years left, it is going to be referred to as a bond if the initial maturity on it was 10 years or more. Okay, now let's talk about the components of a bond in general. Bonds are used to raise capital for companies. A bond is a debt instrument, meaning they are not selling any ownership. Rather, what they're doing is giving you a promise to pay you back. Now, bonds have a liquidation preference, meaning should bonds go sideways, like if it's corporate bond and the company is not doing very well, then the bondholders get paid first. And only if there's anything left over after the bondholders get paid, then the stockholders get paid. The issuer of the bond, whether it is a company or the government or the U.S. Treasury, they owe the customer the face value of the bond at maturity, and they pay interest in the meantime, which is considered the yield. There are two components to a bond, the price and the yield. They have a seesaw relationship, meaning they have an inverse relationship, a seesaw. As a mortgage lender, we will see this in our pricing sheets when we're looking at what rates are doing. For instance, if bond prices go up, then it causes the interest rates to go down. If bond prices go down, then it causes the interest rate to go up. Okay, so that inverse seesaw relationship is what we're going to see. Next thing to understand is that there are different types of interest rates connected to the bond. The nominal interest rate is the interest rate before taking inflation into account. As such, it is just the coupon rate. The real interest rate measures the bond's actual buying power, meaning it takes into account the rate of inflation. For instance, if inflation is high, then it will eat into the bond's buying power. The effective interest rate takes into account the compounding interest rate. By this, only applies if the bond is being reinvested. The coupon rate determines the interest being paid to the bondholder. For instance, if you own a bond at $100,000 with a coupon rate of 4%, then you will have an annual payment of $4,000. Okay, these are the components of a bond. Now let's get back to the idea that mortgages move with 10-year treasury bonds. Remember, they are not pegged to each other, but they do tend to move together. Why? Well, the mortgage-backed securities tend to compete for the same dollar as the 10-year treasury because they both have similar durations. Okay, they're both long term, whereas the federal funds rate is a short term instrument. So an increase in the federal funds rate is not going to have a direct impact or a direct correlation, I should say, to a mortgage-backed security because it is a short-term debt instrument. So the increase in the federal funds rate, which is the rate that the banks lend to each other overnight, will have a direct or more correlative effect to short-term rates like credit cards or car loans or things like that. However, as we've seen, when the Fed does something to the federal funds rate, it has had an effect on the mortgage interest rates. However, the charts that I tend to look at in addition to this is going to be the UMBS 30-year chart and the US 10-year Treasury chart. There will be another video that comes out that discusses how we look at these charts. What are the different triggers and how do you read these charts? That will help you in understanding how mortgage rates move. And whether you're a consumer or whether you are a lender, it is very important to understand these components so you know why interest rates are the way they are. If you have any questions additionally about bonds or interest rates or how they're moving or why they're moving the way they are, please feel free to contact me. Remember, I'm licensed in California, Nevada, Arizona, and Washington as of the date of this video. Thank you.